What's going on, everyone? Welcome to the Nomad Hedge. If it's your first time here, welcome to the channel. In today's video, we're going to ask the question if the market's going to rally next week, because boy, it's going to be a very interesting week next week. We do have the CPI report on Tuesday, as well as the upcoming FOMC meeting, whereby they're going to decide on interest rate hikes. And so the market's pretty much priced in here on 50 basis points. But the question is, what is the market going to do? How's the market going to react? And there's some very important technicals that we have to take a look at to sort of like build a puzzle and see where it's going, okay? So first of all, if we take a look at what we're going to get on Tuesday, we do have the inflation rate, the CPI basically month over month, and we do have the core and the core again year over year. And so the expectation now for the CPI is to come in at 7.3%. Anything above this level, the market's going to tank, okay? But whatever the results we're getting here, the market has always been trying to fight the Fed, okay? So we've been getting bad reports after another. We have seen the market sort of like rally sometimes because the Fed wants to reduce inflation and they want to ease financial conditions. They don't want optimism in the market. They don't want people to go out there and spend. They want to slow down the economy. So we know that the market's been fighting the Fed and we have high inflation still. And then obviously on Wednesday, we're going to get the FOMC meeting. The market's already priced in at 50 basis points. However, we've seen and heard Fed officials talking about 7%, and we could possibly see an even higher terminal rate than 5%. So the tone has been very aggressive recently, and the market is sort of like trying to cope where everything is going, when the Fed is going to pivot, etc. Okay, so let's begin with the SPY here. So I mentioned earlier that the technicals is sort of like speaking its own language here. And in order to find out how the market is going to perceive all this, we have to look at the bond market. Okay, but first of all, let's take a look at the SPY here. Actually, let's move on to an hourly chart here. And as we can see here, we do have a strong support level right here. Okay, so we can see there's a resistance here. We broke above resistance, acted as support, support again. So any break below this thing is going to mean that we're going to most likely fill up this open gap, test this fib 0.5 level, breaking that below. And if we're breaking this one, we're going to make new lows. So let's move on now and take a look at the dollar index, for instance. Okay, so we're looking at the dollar index. So what are we seeing here? We're seeing a bull flag being, built up here. Okay, so we can see that we have had up and down days here, potentially finding resistance here at the 200-day moving average if we're trying to make another leg up here. But I mean, from an Elliott wave perspective, we could possibly see another leg down here and then make another move to the upside. We know that the dollar, whenever the dollar goes up, it has an inverse relationship with the equity markets, and stocks tend to fall, and vice versa. But we have to take a look at the 10-year as well and see how the bond market is faring out. Now, the good news is we broke below this higher low trend line here, confirming the bias that the yields are dropping, along with the dollar is dropping as well. But we also have this falling wedge here. And I have mentioned in another video previously that we could possibly see another leg up here before breaking down. So by taking a look at the technicals here, we can see a falling wedge here, and we do also have this Elliott wave pattern. It's not confirmed yet, but I mean, this is the closest we can get right here. So we do have a 5 wave here. We have the A wave here being almost completed. We could see another pullback here, but then the C wave would confirm this breakout. However, we do also have some resistance ahead here. And if we take a look at closely here, we do have this higher low trend line here coinciding with this 21-day exponential moving average and this critical 50-day moving average. However, because the Fed is raising rates, that's going to support the dollar, and typically that attracts more investors to the US dollar. They're going to place their money in the treasury bonds. Okay, so the treasury is going to try to attract more buyers here, and that's why I think that we could possibly see another leg up here before breaking down completely in the future. Okay, so this is a possibility. When I'm looking at technicals here, I'm seeing a breakout here. So if you move on to the 2-year, we haven't broke below this high low trend line here. Unlike the 10-year, we are below it. This thing is still intact. So what are we seeing here? Well, I mean, the indicators are speaking for themselves. We're still pretty much neutral here on the RSI. We do have a MACD buy signal here in a very strong divergence here towards the upside on the MACD. We do have confluence here with the 21-day exponential and the 50-day moving average. So if the 10-year is going to move up, most likely, we're going to see the 2-year sort of like replicate the actions on the 10-year. And so now we know that the dollar index is setting up for a buy here We're seeing the 10-year is setting up for higher yields, and we're seeing the 2-year haven't even broken out yet, but we could see that this 2-year could follow the 10-year towards the upside. Okay, and if we move on here to a weekly chart on the 2-year, we're seeing this pattern here, and we're fairly overbought here on the weekly chart. But one could make the case, okay, well, we do have a sell signal here on the MACD, but look at these sell signals here. We had a couple sell signals here, and these were fake sell signals, so these weren't reliable. So every time this dip, we saw another buy signal here towards the upside, which could give us a hint whether we could see another leg up here on the 2-year before breaking down completely. And if we take a look at the 2-year here, this is also interesting here, the 2-year here on the monthly chart. Yes, we found resistance here at the Fibonacci extension of 1.618, but we can't rule out the fact that we do have a resistance here. So another leg up is possible here, finding resistance at these previous levels, then make its way downward, which could confirm that we could possibly see, another leg up here. So that's just something to think about. We've looked at the dollar index now, we've looked at the 10-year, and this finalizes the 2-year. However, let's move on to the VIX, not the VXX, the VIX. And the VIX has confirmed. I mean, we are now in a high volatility situation here on the VIX. We found support here. We even broke below this one very cautiously, but we still have an open gap here. But the VIX is above this trend line here, which would suggest that we would see more volatility ahead. And I mean, these patterns have followed the S&P. So whenever we see VIX spiking here, the S&P have fallen. So now we are in a confirmed uptrend here on the VIX. And if we take a look at the VIX here on an intraday 15-minute chart, we can see that we've been moving sideways here. Okay, so we broke above here, and now we've basically been moving sideways. So these are pretty bullish patterns here because we're only seeing some sideways consolidation before its next move higher. Okay, so if you take a look at the indicators on the VIX, we can see that we're fairly neutral here on the RSI, suggesting we still have some leg or room towards the upside. The MACD has cleared a buy signal or an early buy signal here with the momentum confirming towards the upside, and we're also seeing that the ADX is also closing into a buy signal here. So the VIX is confirming higher volatility ahead. The dollar index is setting up for a buy. The 10-year and the 2-year is setting up for another leg move up higher, and the VIX is telling us there's going to be more volatility ahead. Which leaves us with the question, are we going to see lower asset prices ahead of the the inflation report, or whether that be the FOMC meeting? Okay, so we know the Fed is going to raise rates anyways. Okay, so the Fed is going to come up with their 50 basis points. I mean, what this suggests with the technicals and the with the indicators, we could get a very bad print on Tuesday. That would mean that we make new lows here, and so the only thing that's going to rescue the S&P here, whether this is going to be short term or not, it's going to be the 50-day moving average. If we break below the 50-day moving average, boy, I'm telling you, this is going to make new lows here. So we don't have any more support here. Yes, we can take a look at the Fib 0.618, but there's also a bullish case. Why? Because we know, as I said previously, like the market has, since the start of the year, always fought the Fed. Whatever the Fed is doing, the market has done the opposite, and the Fed doesn't like that. We also have record, stock buybacks coming in. I mean, things are setting up in a way that we could see a lot of sell-off in the short term, but in the intermediate term, that would tell us that we could probably see some more bear markets rally ahead, but we're not anything near the end of the bear market for now. Okay, so that's just a takeaway. I think that we're gonna see sell-off here on Tuesday, whether that be Tuesday or Wednesday, and then we could possibly see some bear markets rallies ahead as we're walking through this bear market. So this is just my take on this, but obviously I'm most likely going to be wrong here because the market doesn't care what I think. So I'm looking forward towards the next week. Thank you so much for watching, and I'll see you guys in the next video. Take care for now. Goodbye.